Hello everyone. Welcome to the webinar, Explore the Impact of the GRE Regime on Charitable Giving. My name is Erin Kuhns and I'm the Manager, Education and Training at CAGP. I'm really happy you could join us here today. I would like to introduce our two presenters, Hayley Maschek, Associate at KPMG Law LLP, and Yolanda Benoit, Senior Manager, Will and Estate Gifts at the BC SPCA. Hayley and Yolanda are joining us from Vancouver today. Now, I have a few quick things to mention before we get started. Hayley and Yolanda will present for approximately 45 minutes or so, followed by a Q&A session. To submit your questions, simply type your question in the questions box on the GoToWebinar panel on the right-hand side of your screen. If they are unable to get to your questions today, they are both also happy to take your questions afterward via email. Their email addresses are on the last page of the presentation. You have received a link to a Dropbox folder which contains a PDF copy of this webinar, as well as Hayley and Yolanda's bios and a CFRE tracker sheet. This webinar is worth 1 CFRE credit, and as with all of our webinars, today's presentation will be recorded, and you'll be receiving an email with a link to the recording afterwards. It will also be available on our website very shortly. So thank you so much for being here today, Hayley and Yolanda. I will let you take it from here.
Hello and bonjour. On behalf of Hayley and myself, thank you for joining us today to explore the impact of the GRE regime on charitable giving. We wanted to give you a quick general overview of the next hour so that you know the flow of the presentation. Hayley will cover the graduated rate estate basics along with premortem and postmortem planning information. I will address the best practices for charities, and then we'll open it up for questions if we have time. I'm hoping we will. As we have lots to cover, let's get started. Over to you, Hayley.
Thank you. So let's just dig right in and start with a discussion of the basic rules that apply to graduated rate estates, which I will refer to as GREs throughout the course of this webinar. So first, I would like to cover the donation tax credits as they apply to GREs. Now, in general, when you make a charitable gift, you'll receive a receipt that's equal to the fair market value of the property. Donations can generally be claimed up to 75% of net income. For donations by a GRE, the credit limit actually increases to 100% of net income in the year of death or the immediately preceding year. We will discuss this flexibility shortly. Certain types of gifts, being ecological gifts and gifts of cultural property, can be claimed up to 100% of net income. And to the extent that there is a gain or recapture that is triggered by making the gift, the 75% limit is increased up to 100% so that there is no tax. And then to the extent that you cannot claim the entire gift in the year that it is made, you can carry it forward for up to 5 years. Now, the tax credit from making a charitable gift is at the lowest rate of tax for the first $200 and at the highest rate of tax for the remainder, provided that your income is over the highest marginal tax bracket threshold. Otherwise, the federal credit is at the 29% tax rate. For BC, there is no taxable income threshold, and we've noted the credit rates up on the slide for your reference. Estate gifts are now considered to be made at the time that the gift is actually made by the executors of the deceased estate and at an amount equal to the fair market value at that time. Now, because the gift is no longer considered to be made immediately before death, the tax return will have to be filed without the gift and then subsequently amended. And this can give rise to cash flow issues as there will initially be taxes otherwise payable without the benefit of the donation. If the taxes are not paid, there is an exposure to interest until the donation is made and an amended tax return is filed. Donors should be advised of this as they will want to make arrangements, or they may want to make arrangements to ensure that the gift can be made as quickly as possible post-mortem and or that their estate has sufficient liquidity to cover the interim tax cost. There are a number of significant benefits available to graduated rate estates. First, they're taxed at graduated rates. All other testamentary trusts are subject to tax at the highest marginal tax rate, both federally and provincially. And we'll walk through a numerical example of this later. GREs are also able to select off-calendar tax year ends. All other testamentary trusts must have December 31st tax year ends. GREs can therefore maximize the benefit of their access to these graduated rates of taxation by creating 4 tax years instead of 3 within the 36-month window that we'll be discussing on the next slide. By choosing a tax year end of some date prior to the first anniversary of death, an extra tax year is created within the normal GRE period. If the estate qualifies as a GRE, there is additional flexibility that is available regarding the use of the donation credit. GREs are also subject to 0% capital gains inclusion rate on the donation of publicly traded securities and gifts of ecologically sensitive land. And finally, while it's actually beyond the scope of today's webinar, the ability to minimize tax in the estate using certain post-mortem tax planning, and in particular so-called loss carryback planning, is limited to GREs. So it is not available to estates that have not designated or qualified as GREs. So now that we know that it is fundamentally important that the estate qualifies as a GRE, the question is, how does the executor ensure that this is the case? A GRE is defined to be an estate that arose on and as a consequence of the death of the individual, if each of the following criteria is met. No more than 36 months have passed since the date of the death of the individual. The estate is a so-called testamentary trust. The individual's social insurance number is disclosed in the tax return of the estate for that year and for every prior taxation year that ends after 2015. And the estate designates itself as a GRE in its first taxation year that ends after 2015. And finally, that no other estate designates itself as a GRE of that individual. We'll come back to these questions as relevant throughout the webinar. Now, provided that the estate qualifies as a GRE and the gift is made within 36 months from the date of death, or if it is made by a former GRE within a further 24 months, there is flexibility in how that gift can be claimed. Now, you might be asking yourself, well, what is a former GRE? Well, it's simply an estate that meets all of the GRE conditions, except that more than 36 months and up to 60 months have passed since the date of death. The donation credit can be claimed in the deceased's terminal return and the immediately prior year up to 100% of net income, as I said earlier. It can also be claimed in the year of the gift, or the year that the gift is actually made, or in any prior year of the GRE. It's not clear why, but we wanted to note that a former GRE cannot claim gifts in its prior years, so in its former GRE years. And the gift can also be claimed or carried forward for up to 5 years, assuming that the estate continues to exist and has income that is subject to tax. Now, I mentioned that a former GRE cannot claim the gift in its prior non-GRE years. This concept is most easily explained with an example. So let's say that you have someone who passes away today, and their executors select an August 31st fiscal year end in order to obtain 4 tax years that are taxed at graduated rates in that 36-month period. The last GRE tax year is going to run from September 1st, 2021 to September 12th, 2021. And then there's going to be a deemed year end upon the loss of the GRE status. Suppose now that the estate is involved in litigation and the gift isn't made until almost the end of the allowable 60-month period. In this case, the gift can be carried back to the 4 GRE periods, but cannot be used in the years ending December 31st, 2021 or 2022. Now, this may not be a significant practical issue if there's not a lot of income earned in those years, but it's really still something that we need to be aware of. Gifts made by non-GREs are not able to make use of the benefits of this flexible donation planning. Donation credits can only be claimed in the year of the gift, up to 75% of net income, and can be carried forward for 5 years. So now that we've covered some of the basics, let's move on to a discussion of some of the things that should be taken into account as part of premortem planning. The first thing to note is that not every gift made will be eligible for the flexible treatment that we discussed. Named beneficiary designations will be eligible, as will property that was acquired by the estate as a consequence of the individual's death, or property that was substituted for such property. So if the deceased owns shares of a private corporation and dividends were paid on those shares, the gift that's made from the receipt of such dividends would not be eligible. But if the shares themselves were redeemed or repurchased, the proceeds would be eligible as replacement property. So for the next several slides, I will be discussing in-kind gifts of property as opposed to cash gifts made using the proceeds of disposition of that property. Now, we all know that the deceased might hold a variety of different assets as of the date of death, and the estate could make a gift, assuming the charity is willing to accept it, of any property held by the estate. For example, real estate, investments, life insurance, or registered accounts like RSPs and RIFs. And as a sidebar here before I go on, I'm going to be discussing the rules as they apply to so-called capital property. For most donors, all of their property will be capital in nature, but things like goods held as inventory for resale would not. In general, where the deceased held capital property on death that is subsequently donated to a charity, the tax implications will be, first, a deemed disposition by the deceased at fair market value on the date of death, and then a subsequent disposition by the estate at fair market value on the date of the gift. Of course, there can be value shifts between the date of death and the date that the actual donation has been made. So to the extent that the fair market value of the capital property decreases in value from the date of death, there will be a capital loss realized, which, if triggered within the first taxation year of the estate, and the estate qualifies as a GRE, that could be carried back to offset capital gains under the so-called loss carryback planning that I discussed or mentioned earlier. And then to the extent that there's a decrease beyond that first year, those losses actually get trapped in the estate and may go unutilized if there are no capital gains in the estate in the future. To the extent that the fair market value of capital property increases in value, there will be a capital gain realized, which can be fully sheltered by the donation credit by virtue of the 25% step up in the allowable limit. The charity would issue a receipt equal to the fair market value at the time of the gift. Now, often that will require an appraisal to support that fair market value, and as many of you already know, the CRA's position is that an appraisal must be acquired if the value is more than $1,000. As I mentioned, the deceased estate can donate investments, which includes both publicly traded securities as well as private company shares. Gifts of publicly traded securities by individuals during their lifetime and by GREs after death are not subject to any capital gains tax and are a very popular way to give as a result. You have to donate the shares to the charity directly, though. You cannot sell them on the market and donate the cash to obtain that 0% tax rate. Remember that this 0% inclusion rate is not available if the estate is not a GRE. This means that if the estate fails to qualify or fails to designate as a GRE, they will be subject to capital gains tax on the disposition of the publicly traded securities to the charity. And of course, shifts in value are not going to be relevant here since the 0% inclusion rate will apply, assuming the gift is by a GRE, to ensure that no tax will arise in any case. If the deceased holds publicly traded shares worth, say, $20,000, having a $10,000 accrued gain, and wishes to make a $20,000 gift to charity, it is clearly preferable to gift those securities rather than to sell it and donate the cash, as tax of somewhere in the order of $2,400 to $2,700 can be eliminated depending on the province. Gifts of ecologically sensitive land will also benefit from that 0% inclusion rate. Note that the estate must be a GRE as before to access this 0% rate. So just be aware that in both of those instances, it's quite fundamentally important. As you may recall, there were some discussions that would also extend this 0% inclusion rates to gifts of real estate and privately held shares. And as I'm sure you all know, the Liberal government announced in its first budget back in 2016 that it would not be proceeding with these proposals. The one thing I found interesting here is that amidst all of the commentary that arose last year in respect of the private company proposals, some have argued that these rules need to be reintroduced. I haven't yet seen the government comment on this possibility, so I think it's a wait and see type thing. As I mentioned earlier, gifts of other capital property should be fully sheltered because there is an increase in the donation credit limit by an additional 25% of the taxable capital gain, and any income from recapture or recapture of capital cost allowance up to a maximum limit of the 100% of net income where that capital property has been donated. Now, recall the cash flow issue and potential interest exposure that I mentioned earlier. This can be particularly problematic where an estate is made up of illiquid assets, or there is a desire not to dispose of the asset to fund the interim tax liability or resulting interest. There is an election that's available to dispose of the capital property at cost. This rule was introduced many years ago to deal with the situation where the capital gain wasn't fully sheltered by the donation credit. Now, this election should address this type of situation, but interestingly enough, the introduction of the GRE regime appears to have given rise to an issue in this context. And the easiest way to illustrate this is with an example. Consider a situation where the deceased was a single individual with no heirs and their entire estate is going to charity. The deceased in this case owned a significant collection of artwork and other illiquid capital property at the time of their passing. Although 100% of the capital gains arising on death should be sheltered by the donation credit, the third-party executors were concerned about the exposure for interest on the unpaid taxes during the period from the date of death to the date that the gift would be made, and that the amended return would be filed. Technically, there is an exposure to interest, as I mentioned, and we're not aware of any CRA administrative policy whereby they would not charge this interest. So what we consider doing in this case is filing the election to allow the gift to take place at the deceased tax cost. By filing the election, both deemed proceeds and the gift are equal to cost. You get a reduced donation credit, but if there are no taxes payable, there's no loss here. And doing so would eliminate the exposure to interest in respect of the terminal return. Now, this worked before the GRE rules were introduced. But when you work through the provision, the result is not what is expected. Instead, it appears to allow the election equal to the GRE's tax cost, not the deceased. So the GRE's tax cost would actually be equal to the fair market value of the time of death. So it appears that any gains that have accrued up to the date of death cannot be eliminated. This doesn't appear to be the correct result, so my colleague and I asked the CRA for a technical interpretation of the provision. They unofficially commented that they are aware of the issue, but they were not able to give us a favorable response at this time. So it looks like this is going to require a technical change to the rules. I guess stay tuned in that regard. For RSP and RIF, the deceased could name a beneficiary name a charity as the beneficiary of the account, or could transfer the account to the charity by will, i.e. by naming the estate as the beneficiary, or by not making any named beneficiary designation. Where a charity is named as the beneficiary of a registered account, the asset doesn't pass through the deceased estate for probate purposes, so probate fees could therefore be avoided through the use of named beneficiaries on registered accounts. For income tax purposes, however, the gift is deemed to have been made by the estate at the time the property is transferred to the charity. This is going to be the case regardless of whether the gift is made by a bequest in a will, via the estate, or by naming the charity as a beneficiary. The donation credit scenarios that I talked about earlier are going to apply here, and the income inclusion on the terminal return will be based on the fair market value as of the date of death. Let's consider a quick example to illustrate the impact of changes in fair market value on the registered account between the date of death and the date of the gift. Let's assume here that the deceased held an RSP with a fair market value of $100,000 on the date of death. Now, the fair market value of that RSP had grown such that it was worth $125,000 as of the date the gift was actually made. The rules provide that the inclusion on the deceased terminal return is limited to $100,000, and any subsequent value increases will be subject to tax in the hands of the beneficiary. Well, since the beneficiary in this case is a charity, there would be no resulting tax associated with the increase in fair market value. There is, however, an increase in the donation credit to the estate. since the estate is deemed to have made the gift at the fair market value on the date of the gift, or on the date that the gift is actually made. The result here is that the estate will actually have an increased donation credit available. Assuming the estate qualifies as a GRE, this means that they will be able to offset the $100,000 income inclusion in respect of that deemed disposition on the terminal return, and will still have some additional donation credit available to offset other gains or income. Now, if there's a decline in value, provided that the gift is made by December 31st of the year following death, the decrease will reduce the amount that is available, or that is taxable, I should say, in the terminal tax returns. Let's consider a scenario, though, where a named beneficiary designation, or more specifically a lack thereof, can result in some complications. In this example, we have a donor who has a RIF with no named beneficiary. All of the donor's other assets are held through an alter ego trust. In this scenario, the deemed gains on the RIF will be taxed in the deceased's terminal return. And assuming the deceased estate is a GRE, a full donation tax credit would be available to offset the taxes on the terminal return once that gift is made. But what if the will is challenged and the gift isn't made until after the terminal return filing deadline? Who should fund these taxes in the interim period between the terminal filing due date and the date that the amended T1 is filed? And even if the tax isn't remitted, who's going to fund the interest that would otherwise result on those taxes owing? Well, if the alter ego trust funds those taxes, the estate could actually lose its GRE status, with the result that the donation can't be carried back to offset the RIF income inclusion. Any donation credit in that case would just be available for carry forward in the estate, but there won't be any income, so the credit would end up unutilized. And the bottom line here really seems to be that if the proceeds of a RIF or other registered account are being directly given to a charity, the best practice would be to use a named beneficiary designation, with the additional benefit of no probate fees and maintaining privacy over the gift. Many of you will have heard of or seen charitable remainder trusts. These also appear to have been impacted by the introduction of the GRE regime. As quick background, the CRA had an old interpretation bulletin dealing with charitable remainder trusts that essentially said that provided that you had a situation where there was a transfer of property to an inter vivos or testamentary trust, all of the income would go to the income beneficiary during their lifetime, and then the capital would go to the charity on the death of the income beneficiary, and there was no ability to encroach on the capital. Then it was their view that there was a donation of the capital interest to the charity having a fair market value equal to the discounted value of that interest, taking account various factors. Now, under the old rules, or the old pre-GRE regime, the gift was deemed to be made immediately before death and could be claimed in the terminal tax return in prior year. But for 2016 and subsequent years, the gift of the capital interest is actually made by the GRE. And the question is, does the gift qualify to be carried back? The CRA has recently released a technical interpretation that essentially resulted in them disallowing the ability to apply the donation credit on that terminal T1 or the prior year. And we've written in for some further clarification to try to get a more favorable result, but we haven't actually had a response yet. So really the bottom line here is that the details are well beyond the scope of this webinar, but suffice it to say, this is a really complex issue. It's still unclear. If you're dealing with a charitable remainder trust, I would suggest consulting your professional advisor. So now that we've considered some of the issues that come up with respect to pre-mortem planning, let's move on to highlight some of the action points that have come up post-mortem. It's fundamental that the estate designate itself as a GRE when filing the tax return for its first taxation year. This designation cannot be late filed, and I cannot emphasize that enough, except, interestingly enough, it appears that if the return itself, that first return, is late filed, the designation can be late filed as well, as long as they are filed together. Just something to keep in the back of your minds. The CRA has said that the designation can be made by simply selecting the GRE box on the trust return or T3 jacket. But frankly, as a best practice, particularly where we have a significant estate, we often suggest attaching a separate letter, making the designation for some additional comfort. There's really no downside risk associated with that. It's also really important that the executors watch for situations that could taint the testamentary trust status and therefore throw the entire estate offside of the GRE requirements. There cannot be contributions by persons other than the deceased. So what kind of contributions are we thinking about here? Well, let's suppose the beneficiary disclaims their entitlement, or a beneficiary pays a capital expense on behalf of the trust. Those are very problematic. There also cannot be so-called offside loans to the estate, and practically speaking, what this means is that where the trust receives a loan from a beneficiary or any other non-arm's length party, it has to be repaid within 12 months or such longer period if you actually apply in writing to the CRA. Now, I just want to take a little bit of a step back and revisit the benefit of access to graduated rates of taxation. One of the most significant changes that came in regarding the taxation of testamentary trusts is that all testamentary trusts, other than those that are a GRE or a qualified disability trust, will be subject to tax at the top federal and provincial marginal tax rates. And as I've alluded to, the GRE regime allows a GRE to have access to graduated rates for up to 36 months. From a BC perspective, and I apologize, but the rest of you can just apply your provincial tax rates. I just want to look at the tax rate advantage and the potential annual tax savings. The first example, we'll just assume that the beneficiaries of the GRE are all taxed at the highest marginal tax rate in BC, which is 49.8% in 2018. And what this means really is that the beneficiaries all have significant other sources of income that will result in taxable income in excess of the top bracket. Secondly, we'd like to assume that the GRE also has regular income, let's say interest income in this case, in excess of that top bracket, which you'll see on the slide there is $205,843. But what we're looking at here is that we want them to utilize the entire graduated rate up to that highest marginal rate of tax. And we're also going to assume that all of the planning is completed so that the deceased estate does indeed qualify as a GRE. The results here are an annual tax savings of almost $31,000, as you can see on the slide. Now, if you multiply this by 3 or possibly 4 tax years, there are potential savings of somewhere in the order of $100,000 to $120,000 over the GRE period. So this example shows that there can still be a significant advantage to accessing these graduated rates if there's a GRE and your beneficiaries are at the highest marginal tax rate. However, the example also illustrates that you need a pretty significant portfolio or some considerable income being generated to achieve these savings. So to put this in perspective, let's assume there was a 4% rate of return. The GRE would need to have more than $5 million of capital in order to earn sufficient income annually. So these are not small estates that we're looking at. What if the estate is smaller and there's much less capital? Let's say $1 million, just for example's sake. Again, using the assumed rate of return of 4%, that would mean we've got $40,000 of income that's subject to tax. So for this example, the results are an annual tax savings of almost $12,000. But again, if you multiply this over 3 or 4 possible tax years, there's potential savings of $30,000 to $40,000 over the GRE period. This is still a significant amount of money that could otherwise be available for a charity that is a beneficiary of the estate. So I know that's a lot to absorb. I hope I've made it clear, at least through this discussion, just how fundamentally important it is to ensure that the estate qualifies as a GRE, particularly in the context of charitable giving. So I'm going to turn it over now to Yolanda, and she will discuss some of the best practices and important things to consider from the charity's perspective.
Thank you, Hayley. One of the best practices for charities is to educate the parties involved in the estate from the beginning. Yes, professionals do keep up with their learning and changes within their industry, but they don't all necessarily specialize in estate administration and estate accounting. And wouldn't you agree that there's been a lot of changes in the last several years? If your charity is a residual beneficiary of an estate, it is in the best interest of your charity to do what you can to inform the parties involved in the estate as to the graduated rate estate so that the executor can maximize the value of the estate. So when I say parties involved, who I'm talking about are the estate lawyer, the executor, and the estate accountant. Usually a charity's first contact is from the estate's lawyer. We typically receive a letter enclosed as a P1 notice and a copy of the will. In my experience, the majority of P1s note that the lawyer is the contact for the estate. Now, if our charity is a residual beneficiary, my team responds with an initial response letter to the lawyer, which includes the paragraph on the slide, which addresses the GRE. I'm not going to read it just for the sake of time. You may not know if this particular lawyer has a lot of experience with estates. So this paragraph will gently bring the GRE to the lawyer's attention, and if they are unaware of what a GRE is, perhaps they will look into it or ask for more information. Next slide. Again, keep in mind, not all lawyers specialize in estate and estate administration. In that initial letter to the estate's lawyer, you have the opportunity to engage and educate. Another best practice for charities would be to read the will very carefully. As Hayley mentioned earlier, if the executor has been given the flexibility to make in-kind gifts in the will to satisfy bequests, such as publicly traded stock, the residual beneficiaries should encourage this. If you see such flexibility granted to the executor in the will, include the paragraph on the slide in your letter to the lawyer. Now, remember, this is at the very beginning, like when you're advised that your charity has been left a bequest. You do not yet have a copy of the statement of assets and liabilities, so you don't know if stock is actually one of the assets of the estate. However, you want to plant the seed. Having publicly traded stock transferred to a charity in specie will affect the residual beneficiary's ultimate gift, as you can avoid the capital gains. Again, if the estate is registered as a GRE. Now, after submitting this PowerPoint, I realized that it would also be wise to mention that point, that the estate must be a registered GRE in order for the estate to transfer the stock in specie so that the estate can take advantage of not paying capital gains on the stock. So my apologies, I'm going to have to update my own template at the office. So try to do what we can to educate the lawyer for the estate, who is most likely our contact. Now, the next person we should attempt to educate is the executor. We most likely do not know how much knowledge the executor has. Has the lawyer informed them of what a graduated estate is? Maybe the accountant. Perhaps they've they've been an executor on another estate, and maybe they do have experience with a GRE, but we don't know. Again, in my experience, most executors will not know what a graduated estate is. You will come across two scenarios with executors. The executor may be doing the estate administration by themselves without professional counsel. Again, I always encourage them to get professional counsel. It just makes our jobs easier. Or the executor does have professional counsel. Now, if the executor is doing the estate work themselves without professional counsel, in your initial letter to them, ensure you add the two previous paragraphs. The one asking if the estate will be filed as a GRE, and if appropriate, again, go back to the will and see if the executor has been given that access to transfer gifts. The paragraph offering to accept publicly traded stock in specie if the estate is a GRE. Now, in BC, I will also send an executor, again, if they have no professional counsel, the BC Executor's Guide to Probate and Estate Administration. This wonderful little booklet was written by a lawyer for the Vancouver chapter of the CAGP. It's a great tool, simple to understand for any executor, that the Vancouver chapter members have access to for a nominal fee. I think it's worth every penny. If your chapter does not have a tool like this, you may want to bring up this idea to your chapter. I also suggest to the executor that they should get an accountant that specializes in estate administration and taxation. I usually have some names of accountants that do specialize in this field should the executor ask. Now, our charity can't recommend a specific accountant, but we can give them a list and tell the executor that they'll have to do their due diligence. Now, just an example of how working with an example and trying to educate them works. I had an executor walk in last week into our office without any prior warning or appointment in order to deliver an interim distribution. I sat down with her and had a conversation. Now, in that conversation, I asked her if she would be filing the estate as a GRE. She stated that she was unsure and would ask her lawyer. She didn't know what a GRE was, but she made sure to write down graduated rate estate to bring up to the attention of the lawyer. Now, the executor actually did bring also a copy of the will, which I asked to have a copy of. I quickly noted that she herself, the executor, was a 30% residual beneficiary. So, of course, I pointed out that she would benefit, of course, as a 30% residual beneficiary from the tax savings if the estate was filed as a GRE. So this made her pay even more attention. I also mentioned that she may need to refile the final T1 with the charitable tax receipts to recover any taxes paid. So again, I'm just planting seeds. Of course, I do give a disclaimer when I'm talking to accountants or lawyers or executors or donors. I always tell them that I'm not a lawyer, I'm not an accountant, and I'm not a financial planner. I'm just an estate geek. I just love this field, and I try to learn as much as I can. And it's important that they do work with professional advisors. So do what you can to educate. And of course, I gave her my card in case she had any questions. Now, some executors, you may have noticed, will ask the beneficiaries to sign a consent to distribute early release so that they can make early distributions prior to the 210-day waiting period and get the charitable tax receipts to use with the tax filing to decrease taxes paid. Now, this may have to do with the liquidity of the estate, or it might have to do with not having to refile later. But since January 1st, 2016, the BC SPCA has seen a dramatic increase in the use of these consents. And as an aside, just make sure that you read the consent to distribute early release very carefully and understand what you're assigning, because no two are the same. So the third person you may need to educate is the accountant working on the estate. Never ever assume that the estate's accountant specializes in estate accounting and knows what a GRE is. They may not be informed if they do not regularly work on estate files. Again, this just happened in January 1st, 2016. Estate accounting is very different from normal tax accounting. So what can you do? Well, when speaking to the lawyer or the executor of the estate, offer to speak to the accountant. If you're given permission to speak to the accountant or they reach out to you, again, always remember your disclaimer that you're not a financial advisor, accountant, or lawyer. You just love the field. And do your best to educate. And I know the fundraisers in the audience are thinking, well, what? I'm not an expert. How can I educate an accountant? Well, good thing you're on this webinar, because you can share the benefits of filing the first T3 as a GRE by, using this slide deck as a resource and giving this to them so they can read through it. You can refer them to various CRA guides online that they can go to themselves and explore For example, the T4011, preparing returns for a deceased person. And Hayley also informs me that there is a number of relevant courses offered by the Chartered Professional Accountants. Okay, so once you've done your best to educate the parties involved in the estate as to the GRE, as a residual beneficiary, the next thing for you to do is review the estate accounting once it arrives. Note how much was paid in taxes. Note how much was received in charitable tax receipts by the estate. Was too much paid in taxes in relation to the amount of charitable tax receipts that should have been used? So you've educated the parties. Now you want to make sure they've minimized their taxes. So you can ask for a copy of the final T1 and the first T3 filed. And that first T3 will tell you whether or not they filed as a graduated rate estate. And again, as a residual beneficiary, you are entitled to request this information as part of reviewing the accounts. So if after looking at the cost benefit, and what I mean by cost benefit is, was more money paid in taxes versus what it would cost to refile with the charitable tax receipts? What is your percentage of the residue? Is it 1% or is it 100% or is it 75%? Is it worth your relationship with the parties involved to question this? If you think it's worthwhile and you've done the cost benefit, then you could ask the executor to refile the final T1 and move forward from there. And again, if the estate was not filed as a GRE, you may wish to review the executor fees being requested. Tax saving opportunities for the estate may have been missed because it wasn't a GRE, and that would be a cost to the estate and ultimately to the residual beneficiaries. The executor did not maximize the value of the estate for the beneficiaries, which is one of their duties, so a lower executor fee may be in order. Again, you have to look at the whole estate administration as a whole. So we have now covered some of the things you can do as a charity once you're notified that someone has passed and your charity will be receiving a bequest. Now let's look at a few things that you can do while your donors are alive and you're engaging and stewarding them. There are some seeds you can plant. So when meeting and engaging your donors, when the opportunity arises, encourage them to work with their team of professional advisors when it comes to estate planning. As Hayley covered earlier, discuss with your donors the importance of their estate having some liquidity that is easily accessible to ensure those first taxes can be paid. If you learn that your donor has publicly traded stock, encourage them to include language in their will that will allow the executor to make in-kind gifts, particularly to charities. Inform your donor of the importance of filing the first estate return as a GRE and encourage them to include language in their will to prompt the executor to designate the estate as a GRE. And then, of course, you can also discuss tax-effective estate gifts to make to a charity. For example, they can donate an RSP, RIF, TFSA, or life insurance policy directly to a charity under a named beneficiary designation, meaning not in the will, but on the product itself. This will keep, as Hayley covered this will keep the assets out of the estate, so no probate fees or executor fees are charged on these assets. Again, when talking to your donors about this type of stuff, don't forget your disclaimer. You're not a financial advisor, you're not an accountant, lawyer. Encourage your donors to speak with their professional advisors and do make yourself available to meet with them as well, because you're part of the team. So we wanted to note that in many instances, it may be worthwhile for donors to consider making gifts during the donor's lifetime instead of waiting until their death. When you are engaging your donors, you may learn, what is the donor's asset profile? You might learn that they do have a want to make a gift during their lifetime. Maybe you're going to learn that they're actually currently paying a lot in taxes. Well, we've encountered a number of situations of high net worth individuals where everything will be gifted to charity upon their passing, yet they are paying current taxes today, either personally or in their corporate groups. This doesn't make sense, both from a tax point of view and from a philanthropic view. At KPMG, they have undertaken a program of significant current gifting, and my team at the BC SPCA works closely with the major gifts team to identify potential lifetime gifts, which give donors both the tax benefits during their lifetime as well as personal satisfaction of seeing the results of their gifts. Thank you for your attention, everyone. Hopefully you will have picked up at least one gold nugget of information. Now we'll turn it over, I guess, to Erin for any questions that may have been sent.
Okay, so that was great. So far we have one question. So if you'd like, I'll ask it out loud and then you guys can respond to it. Back to gifts in kind of property. So this is early on. If the charity immediately sells this property, do they still require an appraisal, or would the sale be considered FMV? Fair market value, I guess.
Yeah, so practically speaking, I think if the charity is comfortable that this sale was an arm's length sale and establishes a position that this is fair market value, I think it's reasonable to rely on that, assuming that sale happens immediately. The CRA does have their stated administrative position, but they're not unreasonable, generally speaking, in this context. So I think that as long as you're comfortable and can establish, and I would suggest maintaining paperwork to do so, that this is truly an arm's length sale that is indicative of true fair market value, I think that would be fine.
Great. Would you like another question? We just got a couple more.
Sure.
All right. I thought executors could pre-file donations on the T3, even if they haven't been dispersed yet, especially if the gifts are specific and the exact amount is known.
So our understanding is that the gift has to actually be made by the estate in order for that gift to be claimed and in order for that to be filed on the T3. If you have, maybe the person who asked, if you have a specific example that you're curious about, I would suggest maybe send me a quick email and I will take a look into it. I'm happy to try and help out with the specific details.
Great. Okay, I have a third question. Are you putting anything on GREs on your website? Is anyone on the webinar doing this? Could be a good way to plant seeds. I guess that's for AGP.
It's a good question. Actually, my team and I just had a conversation with our communications department yesterday about adding a page to our website specifically for executors. And one of the things that would be addressing the GRE and planting the seed there. Absolutely, it's a great idea.
Okay, another one. If primary residence is part of a GRE estate and residence increases in value from DOD to date of sale, is capital gain owing on difference in value? Is the answer different if 100% of estate is going to charity? Do you want me to repeat that?
Sorry, and it was principal residence was the specific fact?
Do you want me to repeat the question?
Sure.
Okay. If primary residence is part of a GRE estate and residence increases in value from DOD to date of sale, is capital gain owing on difference in value? Is the answer different if 100% of estate is going to charity?
So I'm answering off the top of my head here, and I would want to take a dig through the rules as a typical tax geek. But off the top of my head, there shouldn't be any tax resulting associated with principal residence. So there shouldn't be any capital gain donation or otherwise. But that I have an asterisk beside that I would want to double check. But that is my recollection of the rules, that as long as this is truly a principal residence, that should be fine.
Another one, if they do not designate GRE, they can still transfer securities and benefit for the special treatment of the capital gains tax.
So there are only two instances. So you get the access to 0% rates if you are an individual who gifts publicly traded securities during your life, or if you are a GRE after death. If you are a non-GRE, the rules do not allow access to that 0% rate. You do still get the charitable tax credit and can use that to offset the tax otherwise resulting, but you don't get that double whammy of no tax plus charitable donation credit.
Great. And just to clarify that question about the posting on the website, it was meant for charities. They just clarified. And here's another question. For any directly designated gifts to a charity from an RRSP, RIF, or segregated fund, who is tax receipted? Should the tax receipt be in the donor's name or the name of the, or to the estate? I guess to the name of the estate.
Yes, it's funny, this question just came up. We were discussing it as we were preparing this webinar. So because the gift is deemed to have been made by the estate, the donation credit or the donation receipt, should be in the name of the estate.
Great. Okay, one more. Can income be allocated out to beneficiaries in the first T3 and thus avoid direct taxation by the estate?
Yes, generally speaking, that should be the case, that you can allocate out there, make the income paid or payable to the beneficiaries to avoid that taxation. That's assuming there isn't another reason, such as some kind of willed variation concerns or any kind of confusion or concern around what the quantum of the various gifts and or bequests will be.
That's great. That was our last question. I mean, we can leave it just for another moment to see if we get a couple more. And then, so we just got one more. Principal res designation is only up to DOD. If so, an increase in principal res value until date of sale is considered capital gain. Does that make sense?
I'm sorry, again, that relates to the other question. I do think I just want to check the technical rules. So,
okay. Principal residence designation. Okay. So would you prefer it if that person emailed you?
Yes, please. I do want to double check the rules because I just haven't looked into them, frankly, recently.
Great. Okay, and we have another question. Can you clarify the name on the receipt for the RRIF when there is a direct designation and not through the estate?
So what they're saying is when they pass, they put the name of the charity or the individual on the actual RIF, and they die.
Right.
And
yeah.
They get the RIF.
Yeah, it's such an odd thing because factually speaking, I know the individual clearly made the gift, but because of the tax rules, the gift is actually deemed to be made by the estate, and so the receipt should be again in the name of the estate.
Okay. Well, I think that's it for questions. As you have both mentioned, I know that you're welcoming other questions to come through email. And I know one person just threw one last one in, so why don't I ask it and then we'll tie things up. Would CRA for a GRE estate accept a letter from a charity accepting the gift for the executor be due an early filing?
That's a good question.
That's old rules.
Yeah, it's not clear to me that would work. Frankly, it would be worth putting a call into the CRA to see if that's possible. I mean, generally speaking, under the new rules, the gift has to actually be made in order to file and claim that donation credit. So I would suspect their answer would be no, but I would be curious and pleasantly surprised if it's otherwise.
Okay, well okay, that's great. I just got one more question. Do you want me to ask it?
Sure.
All right, we have another couple minutes. Why is a separate letter given as well as checking the box on T3?
It's a good question. A lot of people, even my own colleagues, ask us that because the CRA has said it's unnecessary. I am a dot my I's, cross my T's, and then do it all over again type of person. So that's why, especially in these multi-million-dollar estates, we're attaching a letter just in case somehow you accidentally clicked the wrong box when you filed the T3 and the jacket is wrong. At least you have that letter to hopefully clarify that. Is it necessary? No. We use it as a best practice, and frankly, it's just because with these big estates, I don't want to take any chances. That's really all it is.
Okay, well, I think we'll tie things up there. Hayley, do you just want to move your screen forward to the last slide? That's okay.
There we go.
There we go. So thank you, everybody, for submitting your questions. Just to remind you, Hayley and Yolanda have included their email address on their presentation here, so you are welcome to email them if you have more questions. You will be receiving an email shortly. It'll have a link to the recording and a short survey to complete. We would appreciate it if you could take a moment to fill out the survey, as it gives us valuable feedback that helps us when planning future webinars. And please join us for the first webinar of our new season of our Webinar Wednesdays series, when Adam Aptowitzer will present Diving into Gift Agreements on September 26th. And also, registration is still open for the Advanced Canadian Gift Planning Symposium taking place at Carleton University in Ottawa, October 17th and 18th. It is filling up, but there's still some space left, so you might want to register soon if you intend on attending. And registration is also now open for the next Original Canadian Gift Planning course, which is taking place at the Banff Centre, February 4th to 8th, 2019. It fills up really fast, so I do recommend registering soon for this. Details about these events are on the CAGP website, and as always, if you have any questions at all about any of our programs or webinars, you're more than welcome to call me anytime. So Hayley and Yolanda, I want to thank you so much for presenting for us today. You did a terrific job. It's been such a delight to have you, so thank you very much.
Thank you.
Thank you.
I wish you all a great rest of the week. Bye.